Hey folks, welcome back to WoSS Capital and to this week's Market Analysis Explainer, covering the week of May 25th to May 31st, 2026. What we're looking at this week isn't a noise event. It's not a headline spike that reversed by Thursday. What we saw in the final week of May was a genuine distributional shift, a real change to the probability surface across the medium term. We're going to work through exactly what moved, why it moved, and critically, what hasn't resolved yet. Here's the structure, the shift itself, the deal probability signal, how to read the yield move, the macro data, mechanical risk management, and the updated scenario weightings. Let's get into it. The core thesis this week is simple but important. Three macro forces converged in the same week, and that concurrence is what makes this analytically significant rather than just noise. First, the US and Iran reached a tentative 60-day MOU, which stands for Memorandum of Understanding, a framework that took a meaningful chunk of geopolitical tail risk off the table. Second, US Q1 GDP was revised sharply upward to roughly 2.0% annualized, which substantially reduced the probability weight on a near-term growth scare. Third, volatility compressed. VIX dropped below 16. MOVE fell below 75. None of these individually moves the needle enough to matter much, but together, they pulled the left tail of the distribution inward. That's the shift. Now, the headline on the MOU looks constructive: a pause on nuclear pursuit, Hormuz mine removal within 30 days, sanctions discussions opening. But there's two things you need to hold alongside that headline: the documents unsigned, and the critical structural questions, like permitted enrichment levels and disposition of Iran's existing stockpile. They're still completely in flux. These types of issue are precisely what collapsed the JCPOA years ago, and they're still open. So this is a framework. It's not a resolution. That matters enormously for how you weight the risk, and the physical oil market's making exactly that distinction in real time. When the MOU news broke, paper-traded Brent fell over 9%. OMOIL, the Oman physical crude benchmark settled at the Strait of Hormuz corridor by buyers who actually take delivery, fell only 6.3%. The result is a $1.20 OMOIL premium over Brent. Physical buyers moved, but they didn't capitulate. They are retaining a geopolitical risk premium because they're pricing deal probability, not deal certainty. That spread is your cleanest signal, so watch it. The 10-year yield fell 2.61% on the week. Some read that as a growth scare. It wasn't. The mechanism's entirely mechanical. Crude falls roughly 9%. Oil's a primary input into inflation across nearly every sector. Forward inflation expectations reprice lower. Break-evens compress. That's the spread between nominal treasuries and tips. And that compression pulls the nominal 10-year yield down with it. No Fed action required. No growth collapse needed. It's oil-driven disinflation. Full stop. The equity dispersion confirms it. The NASDAQ led the week at plus 2.89%. Lower long rates disproportionately benefit high multiple tech. The Russell added just 0.86%. Small caps are sensitive to domestic credit conditions, and those didn't ease materially. That divergence tells you exactly what the market was repricing and what it wasn't. PCE gave us the classic mixed signal of late-stage disinflation. Year over year, headlines at 3.8% and cores at 3.3%, both still well above target and both higher than March on an annualized basis. But the monthly rates decelerated. Headline month-on-month slowed from 0.7% to 0.4%, core from 0.3% to 0.2%. The annual trend's still moving in the wrong direction, but the marginal momentum is turning. And here's where the oil move connects directly. There's a 1 to 2 month lag before a crude price decline feeds into headline PCE. A near 10% drop in oil creates a credible pipeline for the annual trend to start rolling over in the May and June prints. That's not a certainty, but it's a plausible path that wasn't there a week ago. WoSS's first FOMC is June, no cuts expected, and the market knows it. But how he characterises the oil-driven disinflation risk against the still elevated annual PCE, that framing is the most important communication event of the coming month. 2 Valkyrie model portfolio signals triggered this week. Bitcoin exited Monday night. Gold exited Friday night. The portfolio is now 38% US equity, 16% global developed markets ex-US, 6% emerging markets, and 40% cash. That cash position isn't a bearish call. It's the system preserving optionality while the distribution's still settling. The gold exit is worth dwelling on for a moment. Gold had a positive week. It rose 0.87% and it's been one of the strongest positions since November 2024. The signal triggered anyway, because the signal's not a price forecast. It's a risk-adjusted return framework. That's the entire point of systematic execution. It removes the narrative, it removes the discretion, it removes the temptation to override because the asset's up on the week. Rules-based systems outperform discretion over time, precisely because they don't do that. The distribution's shifted, and here's where it now sits. Bears down to 22% from 32%. The GDP revision, the VIX compression, and the MOU all reduced the near-term shock probability. Base holds at 48%. Sustained growth, decelerating inflation, no cut before Q4 at earliest, geopolitical slow burn without escalation. That's still the modal outcome, and it's more credible now than it's been in several weeks. Bulls expanded to 30% from 21%. If the deal resolves, oil consolidates in the 75 to 85 range, and PCE monthly momentum continues through Q3, the soft landing path is genuinely more accessible. The alpha skews improved to approximately minus 0.3 from minus 0.65, so the distribution's becoming more symmetric. But the negative skew isn't gone. The unsigned MOU, the unresolved enrichment question, the possibility that the oil declines masking genuine demand weakness, the break-even reversal risk if oil rebounds, those are all live tail risks. Volatility's cheap right now. VIX at 15.31, move at 70.22. That makes hedges inexpensive relative to recent history, which is an asymmetrically attractive environment for maintaining selective tail protection. The question to sit with as the 60-day window runs down, are you pricing probability or are you pricing certainty? Because the physical oil market's telling you those are not the same thing. Let the data lead. The full report's linked in the description below. Read or listen on the Substack app. Until next week, stay safe out there. WoSS.